Hello, and we are live. Okay, just a few minutes past 4:30, our usual start time. I thank everyone for sticking with me and staying out there. Just had to prepare a few things, and I hate to say it. Look, I found something. I found something really interesting from a investment firm called Athena Invest. They say they are the premier firm when it comes to uh, behavioral investing. And it started because I saw a post on LinkedIn and it was just like an amazing picture. It was a graphic which perfectly explained how the stock market does based on Republican presidents or Democratic presidents and who, Republican or Democratic controlled Congress. It was just like the best graphic I've seen. And this firm looks like they're putting together some incredible content. And I'm like, they're just giving me such good ideas to run with for data to talk to you about politics because that's what's in the air. We're finishing up the last night of the Democratic National Convention. Next week we head into the Republican National Convention. I find this stuff fascinating. I'm not, I to me this is all incredible and fascinating, and I actually enjoy it. I'm a bit of a news junkie, so this is something that I enjoy thoroughly. So thank you everyone for joining me. Scott, I see you out there. It is nice to see you, my friend. Thank you very much. And I'd love to see you in person one of these days. It's I started seeing some people in person. I saw a friend of mine, Michelle, yesterday. I saw a bunch of people a week before. So little by little, we're starting to I want to say get back to normal, but let's say get back to a revised normal. I don't want to say the new normal because that implies that whatever we're going through now is going to stick forever, and I don't want to accept that yet. So I'm going to say a revised normal until we get back. So we've got a couple of quick things to talk about. I'm going to do your usual quick market update, but with perspective. I sprinkle a lot of knowledge, perspective, and wisdom into the update. So we're going to do that. And then I think that's it. We're going to call quits for the day. It's Thursday. I usually make these live streams on Thursday a little shorter. We're getting to the weekend. The market was up. Not really a lot going on. The weather's gorgeous in the Northeast. I hope it's nice by you. California is getting just slammed with heat and fires. It's awful. But I hope everybody else at least is doing okay. So we're going to roll the quick intro, very quick. We're going to go through the perspective. I always want to make sure you're a better investor. I always want to make sure you're better at personal finance, investing, business, because that's what the show is all about. Be the boss of your money. It's a catchy slogan, but I really mean it. I want you to be the boss of your money instead of your money becoming the boss of you. It's very easy for that to happen. So we've got to fight that. So here goes the intro, and then we're going to roll with it. All right, we are back. This is Be the Boss of Your Money. My name is Mitch Goldberg, and this show is all about business, personal finance, investing, and other items that are related. Lots of subjects that are related to those things, but I want you to become better off financially. I have learned a lot of lessons over the years. Some of these lessons, it's because I got things right, and some of them is because I got them wrong, and I didn't really feel like I had the best mentors in the world when it comes down to a lot of personal finance things. So I had to become self-taught. I hope it's okay to say, and some people watching this might not have known that. My dad did pretty well, but he was great at making money. Let's put it that way. He was the type of guy who would fight you tooth and nail over a paper clip, or a thumbtack, but there was always a leak in the bucket somewhere else on something that just didn't make sense in terms of spending money. I mean, I guess it depends at times, yes, but he was an entrepreneur like me. But when you're an entrepreneur, you have to, I think, play a long game, but play a little bit more of a conservative game. Right now you see how many people have been knocked out of the job market because of the pandemic, and there's a lot of people out there who wish they had more in savings. There are people out there who wish they had more choices and options. It's horrible out there. It's really, really bad out there. And even things that you thought, well, I could just jump into a side hustle, driving for Uber, working at a restaurant, what have you. A lot of those things are knocked out also. I mean, yes, Uber is coming back, but not like it was. So I feel bad for a lot of people out there. And then there are people who are doing just fine. I am very thankful. I'm in a business that has done pretty well through this pandemic. We've skated right through it so far. The stock market's open, so I'm open. Financial planning, wealth management, all of those things continue. They go on, and so I'm grateful for being busy and for the business holding up and doing well. But I feel like sometimes I am whistling past the graveyard, because what happens is, does the stock market go down to catch up to the economy, or does the economy go up to catch the stock market? So far, they've been so divergent, as you know. It's like we're all sick of talking about this, but the stock market's doing phenomenal. New highs, NASDAQ hitting highs all the time. The S&P 500 hit new highs. The Dow hasn't hit a high yet, but it's very, very close. But if you look at individual stocks, you'll find that most are doing pretty poorly, and many are down 50% plus, because certain industries are just getting crushed. Airlines, hotels, casinos, REITs, mall operators, restaurants. I could go on. The discretionary items companies like the Michael Kors of the world, auto sales. Well, auto sales have actually started to pick up again, but still, after what they dealerships went through for the last few months, they need every ounce of metal they could move. So it's a really tough environment out there. And today, the first time unemployment claims came out, as they do every week, and they were over a million again, unexpectedly high. So out of 21 weeks, 20 weeks have been a million plus claims for unemployment. I mean, these numbers are off the chart. I mean, it used to be like, if in the Great Recession, remember one month we had like 600,000 people filed for unemployment, and people were like, oh my God, 600,000 people. Whoa. And now it's like, if we get, only a million, it's normal. I mean, that's how quickly we've adjusted. And we've adjusted to wearing masks too. So these highs in the market, it's tough to be enthusiastic about it when other people are suffering. And they're basically because people are going all electronic. They're all digital. They're all work from home, stay at home. So the handful of stocks in that space are doing so well that they're pulling up the rest of the stock market, the averages. But they're hiding the damage being done to the rest of the stock market, which is reflecting the really lousy economy. Look, in a way, not in a way, but in reality, the stock market is actually doing what it's supposed to be doing. And I know, don't throw eggs at the screen. Hold on, don't throw eggs at me. Don't stop. Don't disconnect just because I said that. I don't mean to be insensitive. What I'm saying is, though, the stock market's doing what it's supposed to be doing, in that it's ruthless. Stock market's not supposed to be emotional. The stock market is picking and choosing winners and losers. The stock market has anointed Amazon, Facebook, Apple, Tesla. We talk about the same names here every day. I'm getting sick of it. I mean, just like I'm getting sick of talking about the same stocks now for the last 5 or 6 months. But the stock market has anointed these giants. If Tesla, by the way, was to go into the S&P 500 today, I think it would be the 10th biggest. Someone was reported on Bloomberg News that it would be the 10th largest company automatically in the S&P 500. I think when they announced their stock split, was at a 5-for-1 stock split, it maybe would have been 20th or 18th. That's how much Tesla has gone up in just over the very near term. Is it speculative? Well, that's a matter of debate. Is it frothy? I sure as heck think so. Yeah, feel actually feel very strongly about that. So, by the way, folks, if you have any questions about the market, investing, personal finance, doesn't necessarily have to be on the main subject of the day, but hit me up in the comments. So, welcome to you, and if you're watching if you're watching this in the replay, welcome to you as well. All right, so stock market up doesn't reflect how bad the economy is. That's been the subject of the day for months and months and months. Stock markets, has fully recovered based on the averages, but the averages are averages. So when I talk about average, think of it this way: I live and work on Long Island, and the average temperature here is something like 55 degrees. It used to be 50. It's like 55 degrees is like the average daily temperature here. But so that means if you have to dress to go outside and you dress for 50, 55 degree weather, and it's like 8 degrees outside or 0 degrees outside, which we do have sometimes in the winter, obviously in the winter, you would be very underdressed. And on the other hand, if we just had a heat wave, we had a lot of 90-degree plus days. So how many days do we actually get where it's truly 55 degrees for the day? Very few. So we talk about averages a lot. So the S&P 500 index, an average, the Dow Jones Industrial Average, they don't really tell the whole story. It's just a place to start, and then you have to dig a little beneath the surface, and you see the absolute horrendous carnage that has been done to so many stock market sectors, like oil, the energy sector, for example, something I did not mention a few minutes ago. Let's take a quick look at the how everything did with a little bit of perspective, and I'll have you on your way. I would love to see you out there. I see Alex is coming in from Facebook. Hello, Alex. Good to see you, my friend. Thank you. By the way, we said hello to Scott already. Scott's also coming in from Facebook. I think most of my viewers come in through Facebook, and then LinkedIn and YouTube is like a very distant third. But I stream to 2 Facebook destinations: my business page, Client First Strategy, and my personal page. If you're watching this and we are not connected, hit me up on my business page, Client First Strategy on Facebook, or my personal page on LinkedIn, Mitchell O. Goldberg. I would love to connect with you, so please do so. And let's just do a quick share screen, and then I'm going to get you on your way. Remember, I don't do these live streams on Fridays. Fridays I do a blast email. So if you'd like to get that blast email, all you have to do is let me know in the DM. I'll get your email address, and I'll start sending it to you. If I may say, I write pretty cool stuff, pretty funky, pretty enlightening. Cover the chicanery that goes on in Wall Street. So the Dow, looked like a negative day last night. It looked like futures would be down about 200 on the Dow because the Federal Reserve gave another very negative assessment of the economy in the minutes from their July meeting, which was just about a month ago. So but people could also look at that as don't fight the Fed. That means more stimulus is on the way. Okay. Oh my God. Hold the presses. Stop the show. Stop. Out. Cut. Hold on a second. Big over here. My cousin Cindy is out there. Hey girl. Miss you. Hi. Broad layman question. Where would you advise to begin your research and understanding of stocks and the market? Yeah, that's like a lot for a 20-minute live stream, of which I think I've used up like almost 15 minutes of. But hey, it's a great question, so I'll just give you my quick answer. Okay. By the way, Cindy is a realtor. I believe in the LA area. So if you are out there, look for Cindy Brodak, and she'll sell your house, get you top dollar. And I see that she posts her victories on Facebook, and I think you should do that. That's terrific. And so anyway, so where do you go for starting out? I would really say just start reading the business section on the various websites like CNBC. CNBC has a ton of personal finance content as well. Go on to Yahoo Finance, and it's really that's where you go. You look for the general market updates, you read them, and even if you feel like I'm not really getting this, keep reading because it won't sink in the first day. It doesn't for any of us, but after a while, you start to see patterns. You start to understand the lingo, the language. Stocks advanced, they went up. Stocks retreated, they went down. Stocks went up because interest rates went up. Well, listen, you're a realtor. You know about interest rates because you follow the mortgage rate like a hawk. The 30-year mortgage, and that's tied to the 10-year treasury. So you follow interest rates, you follow stocks. You start to realize that there's different sectors. There's tech stocks, there's energy stocks, there's consumer staples, and you just start getting into it. And of course, you can always head on to my website, Cindy, because I have like a massive amount of content there. I write in very plain English way, very simple terms, and you could definitely go check that out. It really is a lot. Yes. Los Angeles. All right. LA. I really want to get down there one of these days. All right. So let's go on. And anyway, thanks for watching, Cindy. I really, really appreciate you watching. Hope the family is very well. And okay, so the rise in jobless claims that came out today may be a warning to Congress that the economy needs stimulus. Listen, the economy right now is not able to run on its own. It's kind of like when you start a lawnmower, you pull the cord, get it to turn over a couple of times. Maybe you turn on the choke button, you pump it with a little bit of gas, and then once it's running, you turn off the choke, turn it on to run, and you're good to go. But every time you do that, you stop pulling the cord and turn off the choke and let it run, it just sputters out and stops. That's the economy. The economy just cannot go on its own. Now, we could let the economy go on its own. There's a case to be made that you have to let the damage happen and then the economy grows. Okay. But how much pain do we want to go through? Central bankers have basically gotten into, like the Federal Reserve, have basically softened up to the point where they're looking to make downturns as painless as possible. Politicians don't mind that because if you're an incumbent, and things are really bad, voters want change and you could lose your job. So there's always a power play to push out some stimulus. And nobody who's an incumbent who's up for re-election wants to face voters right now and say, oh yeah, there's no stimulus. You're getting an eviction notice, because most states, evictions are kicking in again. People haven't paid their rent. People have had rent and mortgage forbearance. So anyway, the point is the jobless claims, they're for two reasons. Number one, because of the COVID that's spreading all over the country. All right. Number two, it's just that if people don't have work and they're not getting that $600 a month, a week stimulus, then they don't have money to spend. And even, the CEO of Walmart, they came out with blowout earnings. The CEO said, we did notice when the stimulus stopped, the foot traffic in our store stopped, slowed down. Didn't stop, it slowed down. So that's the problem. It's like, but how much is too much? Like $600 a week? It's really generous. People were paid to stay home for a few months. And if everybody actually did stay home and social distance, we would be out of this mess, or mostly out of this mess, or at least manageable in a way where people could get their jobs back. But that's not the case, unfortunately. And I'm kind of on a rant here. So this is a wake-up call to Congress that we need some kind of stimulus. It doesn't have to be 600 per week, but maybe it's got to be 400 or 500. I think they should. I said this a few weeks ago. Just do like 500 a week until January, and then maybe 400 a week for the next 6 months, and then decide what to do. And it'll be on the lap of the next administration and the next Congress to talk about this. All right. So that's kind of where I stand on that. All right. So let's go on. We're going to take a look at FANG. I am so sick of looking at these stocks. I shouldn't be sick of them. Listen, folks, I do have these stocks in client portfolios, so I'm not complaining, But as far as an economic market synopsis, these stocks, these are the market. These stocks are all up today. How could the market possibly go down when all of these stocks are up? You know, 5 out of these 6 are up over 2%. Amazon's up 1%. 4 of the 6 are trillion-dollar market valuations. It's, Netflix and Facebook are the ones that are still under a trillion, but the way things are going, you could see these also hitting trillion-dollar valuations. Apple at a $2 trillion valuation yesterday. So FANG stocks continue to move. Where was the action? This is my main dashboard. XLK, these are the sector ETFs. Technology, the standout winner of the day. Communications. The communications sector is about half Facebook and half Alphabet and about 5% Netflix. So that's really a tech heavy barometer also. So these two sectors are up a little bit in energy. That's somewhat positive. Staples were a little weak, but let's take a look at the bottom. Energy and financials. Okay, XLI is industrial, XLI is utilities, XLF financials, XLE energy. When you see industrials, financials, and energy weak, that's not a great sign for the economy. And I have to say, I haven't seen any sign of a V-shaped recovery for a couple of weeks. We used to talk about that. All right, so that's where we are in the market. I'm going to stop the share screen. I want to wish everybody a very happy weekend. I know it's Thursday, so they call it Friday Eve now, right? Keep on keeping on. What should you do? Should you invest now? Cindy, you asked the question, where do you, learn and understand and research stocks in the market? Look, over the long term, stocks have a way of going up because you have the management of corporations that do everything they can to build a company. I can't tell you with any degree of certainty if the market could stop going up now or if it's going to go down. And that's not what I'm here for. I'm here to manage through it. If your risk tolerance, a little thirsty, Dunkin'. I'm a big coffee drinker, and Dunkin' is my favorite. My favorite iced coffee. I love this stuff. What you should be doing if you're interested in investing is invest monthly, dollar cost average. Invest the same amount every month. Dollar cost average means you buy more shares with the same amount of money when the stock market is down. You buy fewer shares because you're using the same amount of money, but if the stock market goes up, you buy fewer shares. Just the way the math works. And you do it month in, month out, and just expect that in 15, 20 years, you have a nice pot of gold at the end. If you're looking for not just you, I'm not picking on you. Just if you're looking for the lottery ticket stock, it's fun, make it a hobby. But what happens is what I see is a lot of people spend so much time looking for the lottery ticket style stock that they put aside personal finance. You want to do something to hit the lottery? I'm going to give you the lottery ticket right now. Become really good at understanding your tax return, because in a lifetime, you're going to pay a boatload more in taxes than what you're going to make on any one great hot stock. Generally speaking, you'll do better by saving in taxes. That's one thing that everybody could do. The next thing, invest regularly. But when you invest money, invest the money before you earn it. In other words, well, that didn't come out the way I wanted it to. When you earn money, you get paid. Save a little first and then spend. Because if you spend first with the idea that, hey, I'm going to spend and then I'll invest what's left over, the problem is often we don't either have anything left over, we don't have as much left over, and it just takes away the discipline and it relies on willpower. And like relying on willpower is like the opposite of having a disciplined financial strategy, if that makes sense. So these are things that I think are worth much more to you over time than for anyone looking for the hot, lottery ticket stock. All right, enough of that. We're up to almost 25 minutes. I will see you guys Monday. If you're watching this in the replay, thank you so much. Talk to you soon. Have a great weekend.